Hey, good morning, everyone. Marty Missouri here. It's May 20th, 2023 with your weekly economic snapshot. Have a fair amount of the inputs to our index that I'd like to share with you this morning, but I'm going to run through them really quickly, give you the highlights, and then I'm going to close with a snip or two with some statistics captured by others that emphasize a key point that we've been making about the U.S. equity market here of late. So, folks, I'm just going to jump right in and get moving. The PWA index we think is a good barometer of general conditions. It captures 45 economic data points. There's a little bit of a global flair in there, but the intent is to gauge probabilities, the risk-reward setup, if you will, for the U.S. asset markets. As this little blip right here suggests, we made back the 7 points that we gave up last week. So we're now sitting at about a negative 31, which is decisively in recessionary territory. Doesn't mean we're in recession. It just means to us that odds favor recession in the foreseeable future over continued expansion. As for this week's inputs, I want to start with U.S. retail sales. As you can see, on a year-over-year basis, we're down to 1.6% growth, and you can see quite the downward trend there. However, that also is impacted by base effects, and we're going to talk a lot about that with regard to inflation for the next few months. So on a month-over-month basis, it actually rose by 0.4%. Core retail sales month over month were up 0.7%. The Red Book retail sales survey, which comes out every week, continues to go down, although it was a little bit of tick up at a 1.6% rate. And then online retail sales actually kicked up a little bit this last month. Bottom line is core retail sales rose, and that was 0.3 above the estimate, but it was offset by a 0.1 downward revision in March and 0.5 lower for February. So when you square up the last 3 months, you get a virtual standstill in terms of the growth rate for retail sales. So not as exciting or as positive as the April statistic might suggest. We also got housing starts and permits this last week for April, and you can see housing starts kicked up just a little bit right there, but we like to focus here specifically on single-family activity, and single-family starts actually picked up just a little bit. It was 13,000 more than the previous month. As for permits, which is important because permits lead to starts, they actually rolled over, so they were down on the month. However, single-family permits saw a very nice pop. So that tells you that the decline that we saw here was all about what was the once red-hot multifamily permits. Single-family is interesting. We know we've had quite the dearth in terms of inventory, but no doubt about it, the housing market right here, just in terms of this activity of late, is a net positive. Certainly something to keep our eye on here going forward. So homebuilder sentiment is also something to keep our eye on, and we've had quite the rebound. Now, this, like the PMIs, uses 50 as a dividing line between expansion and recessionary conditions. So we were very much in recessionary conditions, and right now it came back right to that dividing line. This is a survey of several hundred builders who are definitely not, screaming optimism, but back to what would be just barely expansionary conditions. Industrial production came out this last week. On a month-over-month basis, it rose 0.5%. That was a bit better than the estimate. However, we also got a downward revision of 0.4% for March. Commercial and industrial loans saw a decline of $6.2 billion, and suffice to say that that is not a rosy picture as it relates to economic strength going forward. Cass freight data also came out last week. The shipments are back to contracting, And you can also see that expenditures are going down. So on one end, speaks poorly about the state of the economy, and of course that makes a lot of sense based on what we're seeing in the goods space. However, it is somewhat disinflationary, which is positive in a whole different way. And I have to tell you, folks, if there were only one of our indicators to pay attention to with regard to the U.S., it would be the leading economic indicator to coincident economic indicator ratio. And just take a look at how this looks rolling into the past 3 recessions. And take a look at how it looks today. The U.S. Economic Surprise Index, recall that this is very, very noisy, and what it reflects is actual data coming out relative to what economists had expected. And what this says is that right in here, right, data started coming in better than expected, and of late it's coming in worse than expected. So in closing, just a couple of snips relative to the market. This came from Bespoke Investment Groups, one of our premium research providers. Weekend report. As shown below, the S&P 500 is up 9.6% year to date. However, remove Apple, Amazon, Microsoft, Google, Nvidia, Tesla, and Meta. And yesterday, remember, I got into the weeds a little bit on Nvidia. The index would essentially be flat, up 0.6% on the year. Apple by itself is 20% of the move this year. Microsoft is 18%, and Nvidia is 12%. Phenomenal. When such a concentration, when really the results are explained by a handful of stocks, folks, that is anything but a healthy market. Larry McDonald, a well-known and respected analyst on Twitter yesterday, he highlights a handful of stocks just since February of this year, right? Nvidia up 48%, Microsoft up 23%, Google up 17%, QQQ, the ETF that I've been featuring lately on just about every market snapshot, up 10%. Retail sector, retail ETF down 19%. MetLife down 25%, First Third Bank down 33%, Foot Locker down 35%, U.S. Bank down 38%, Macy's down 39%, Lincoln Financial down 39%, Kohl's down 44%. His point, the market is crashing internally, right? That's a big statement right there, but it's hard to disagree with it. Our view is simply that a healthy market, right, is typically one where you see at least most boats rise with the tide. Actually, one more came to mind, so I will close with this one, I promise. This is from Thursday's written blog post. I just showed the bull market coming off of the last 2 recessions, not counting the blip that would be COVID. And this, if you can make this out, these are just all the major sectors. And my point here is just simply the overall trend, right? And you can see these lines to different degrees pretty much move together. So this is all your boats, so to speak, rising with the tide. Here we are 7 months removed from the October 16th bottom, right? October 16th of last year. And those top 2 I just showed you happened to be 7 months removed from the actual bear market bottoms. So again, while indeed that October 16th, for the S&P may indeed turn out to be this bear market bottom, it sure doesn't look like it when we look across various metrics. And since I'm here, I might as well point out, this was the price to earnings ratio coming off of the last, 1, 2, 3, even the COVID blip, bear market. This is October 16th. PE higher than any of these areas here. Price to book value significantly higher here. Again, if that was the actual bottom, it comes from valuations that are notably higher than what you tend to see coming off of a bear market, particularly a recessionary bear market. And then price to sales, pretty dramatic, right, relative to where it typically is. So that would suggest we haven't seen the pain that you would see. Buffett's favorite indicator, market cap, the value of the overall U.S. market relative to the size of the economy. You can see very elevated, even relative to that blip here in COVID. And then Robert Shiller, cyclically adjusted price to earnings ratio. A lot of people have a lot of respect for this one. Again, we got right down there at the COVID bottom, 3-week experience. But you can see historically, other than that blip, we are at a significantly higher level than we've ever been. I always go back as far as I can on the data, and this one takes us back to like the 1800s or something. So if we look at cyclically adjusted valuation here, the price to earnings, we are historically high. So anyway, got off the track a little bit here, folks, but I wanted to add this data relative to the equity markets, which seems to always be everybody's focus. Our focus is on the macro, general conditions and the overall risk-reward setup, and we allocate across asset classes, not just stocks. So for what that's worth, I will leave it there, folks. Thank you, as always, for watching and listening. Take care. Bye-bye.